Most NRIs think their NRE interest stays tax free until the deposit matures, even after they move back to India. This is a myth that can become too expensive for you. Your NRE and FCNR deposits are not the safe havens you think they are once you return to India for good. The truth is, the moment your intent changes from visiting to staying, your tax free status is on a countdown. Hi everyone, I'm Sagar Soman, a chartered accountant and cross border wealth strategist. Over the last 20 years, I have advised NRIs on cross border tax and compliance matters across multiple countries. My work focuses on NRI taxation, FEMA, and DTA frameworks, and I'm currently working as an independent consultant with Belong to help you navigate these complexities. You are watching another episode of the Offshore Advantage, where we break down complex NRI financial topics into simple, practical insights so you can stay compliant, avoid costly mistakes, and make smarter decisions with your money across borders. The day you return to India, two clocks start ticking. One clock is FEMA, the other clock is income tax. Most confusion happens because when we mix these two clocks and then we blame the bank. So let's make this brutally simple. FEMA decides what you are allowed to hold today. The Income Tax Act decides how your income is taxed for the year. And today we are talking about one narrow return to India moment that creates this maximum confusion. What happens to your NRE fixed deposit when you return? And what happens to your FCNRB deposit when you return? One precision point up front, NRE and NRO are bank accounts. FCNR is not a bank account. FCNR is a foreign currency fixed deposit. So whenever I say FCNR, I mean the deposit product, not an account you swipe for groceries. Now let's start with FEMA because your bank will start with FEMA. Under FEMA, you become a person resident in India if you come to India for employment or for carrying on business or vocation or for any other purpose that shows an intention to stay in India for an uncertain period. Read that again in your mind. Employment, business or vocation, or any purpose indicating you are here for an uncertain period. This is not a day count game. This is an intention and purpose test. So in a standard, I have moved back for work situation, your famous status can change right when you land and start living that purpose. Income tax, on the other hand, is a different story. Income tax residential status is tested for the financial year, largely through day count and related conditions. So it is completely possible that FEMA changes now and income tax status gets decided later. That is why I call it two clocks. Now let's talk about what the bank is supposed to do when the FEMA clock changes. RBI's framework is very clear on the direction of travel. When your residential status changes from non-resident to resident, your NRE account has to be redesignated as a resident account or the funds held in the NRE account may be transferred to a RFC account at your option. And let me address the exact confusion many people have. NRE is a rupee account, RFC is a foreign currency account. So the bank does not convert the NRE account into an RFC account. What actually happens is this: your rupee balance in NRE is first converted into a permitted foreign currency at the prevailing bank rate, and then the foreign currency amount is credited to your RFC account. That is why RBI uses the phrase funds may be transferred, not account is converted. Your NRO account similarly can be redesignated as a resident rupee account on your return for employment, business, or any other purpose indicating intention to stay in India for an uncertain period. If you are only on a temporary visit, it continues as a non-resident for that visit. And FCNRB deposits, they are treated differently. They may be allowed to continue till maturity at the contracted rate of interest if you want, but except for FCNR specific features like rate of interest and reserve requirements, for all other purposes, such deposits should be treated as resident deposits from the date of your return. So that is the FEMA side. Now let's go product by product. First, NRE fixed deposits. Here is the biggest myth I want to address. NRE interest is tax free because it is NRE. Wrong. NRE interest is exempt only because the Income Tax Act has a specific exemption clause for it, and that exemption is tied to conditions. Section 10, subsection 4, clause 2 of the Income Tax Act exempts interest on money standing to your credit in an NRE account. But the condition is important. It applies when the individual is a person resident outside India under FEMA or is a person who has been permitted by RBI to maintain that NRE account. So the exemption is not a final label, it is a condition. Once your FEMA status changes and you become a person resident in India, you are generally no longer eligible to maintain an NRE account in the same way. And once that eligibility ends, the Section 10, subsection 4, clause 2 exemption is not available on autopilot. So, what happens operationally to your NRE fixed deposit on your return? The bank has to redesignate, that is non negotiable. The only question is what you choose to do with the money after redesignation. Route 1, the bank redesignates it as a resident rupee term deposit. Route 2, if you want foreign currency retention under the returning resident framework, you can move the funds into an RFC account. And again, understand the mechanics. Because NRE is rupees, the move to RFC is not a direct label change. It is a conversion of rupee into a permitted foreign currency and then a credit into RFC. Now, an important nuance that people miss: redesignation does not always mean break the deposit today and lose your rate. Banks can reclassify the deposit in their books and the deposit can still run to the original maturity on the contracted terms, depending on the bank's process and RBI rules. But if you specifically want to move an NRE term deposit into RFC immediately on return, that may involve premature closure of the NRE term deposit and transfer of funds into RFC. RBI's interest rate directions have a specific carve out for such conversion requests made immediately on return, including guidance that banks should not levy premature withdrawal penalty in such cases. Now, tax. How do you think about tax once your NRE fixed deposit is redesignated? Think in layers. Layer 1. If you are no longer a person resident outside India under FEMA, Section 10, subsection 4, clause 2 is not your default protection anymore. Layer 2. Your income tax residential status for that year then becomes relevant. NR, RNOR, or ROR will decide what gets taxed in India. Layer 3. The product type after redesignation matters. Resident rupee deposit interest is taxed as Indian source interest. RFC deposit interest treatment depends on your income tax status and whether it falls within the specific exemption for RBI approved foreign currency deposits. So the correct mindset is not NRE equals tax free. The correct mindset is which exemption clause am I actually qualifying for today and for this year. Now let's move to FCNRB. This is the deposit people get emotionally attached to because it feels like a protected foreign currency bubble. So let me give you a clean compliant picture. When you return and your FEMA status changes, RBI allows FCNRB deposits to continue till maturity at the contracted rate of interest if you want. But RBI also makes it clear that from the date of your return for permanent settlement, except for FCNR specific features like the rate of interest and reserve requirements, for all other purpose, the deposit should be treated as resident deposit from that date. And on maturity, there is another hard rule. Banks should convert the FCNRB deposit on maturity into a resident rupee deposit account or into an RFC account if you are eligible based on your choice. In other words, FCNR can live out its remaining term, but it cannot keep reproducing as FCNR forever once you have become resident. Now, tax, that is the part that decides whether you smile or cry. Interest on FCNR is not exempt because it is foreign currency. It is exempt because Section 10, subsection 15, clause 4 FA provides an exemption for interest payable by a scheduled bank on deposits in foreign currency where acceptance of such deposits is approved by RBI. And this exemption applies not only to a non-resident, it also applies to an individual or HUF who is resident but not ordinarily resident. So this is your bridge. Non-resident, FCNR interest exempt. RNOR, FCNR interest still exempt because the clause explicitly covers RNOR subject to the RBI approved foreign currency deposit condition. And once you classify as a ROR, FCNR interest becomes taxable in India. So you can return to India, become resident under FEMA quickly, and still have a window where FCNR interest stays exempt under the Income Tax Act because you are RNOR. But once you cross into resident and ordinarily resident category, the exemption door closes and the same FCNR interest becomes taxable. Now, what about RFC in this FCNR maturity story? When your FCNR deposit matures and you opt for RFC, you are still keeping money in foreign currency under an RBI permitted scheme. And during the RNOR window, the exemption under Section 10, subsection 15, Clause 4 FA can apply to RBI approved foreign currency deposits with the scheduled banks, subject to the conditions being satisfied for that specific deposit. Once you become ROR, it becomes taxable. Now let's bring it back to something practical, because otherwise this becomes theoretical and nothing changes in real life. When you return to India, do these three things early. First, declare your change in residential status to the bank. Do not wait for maturity. Banks act on FEMA status, so update KYC and let the redesignation happen. Second, decide your maturity destination in advance. For FCNR, on maturity, you will choose resident rupee or RFC. If you don't choose, you get whatever default the bank's process applies, and that is how people end up with messy conversions. Third, track your status timeline. Date you returned for employment or settlement. Date your bank redesignated your accounts. Date you become RNOR or ROR under the Income Tax Act for the year. Because that timeline is what drives the exemption story. One more thing that is quietly dangerous during this transition: TDS. TDS is not final tax, TDS is withholding. Banks may change the withholding mechanics once you are treated as resident for banking purpose. Your final tax outcome still depends on your actual residential status under the Income Tax Act and the specific exemption sections. So don't take the presence or absence of TDS as a legal conclusion. Take it as a clue that needs reconciliation. Now let me leave you with a clean mental summary without fancy buzzwords. NRE fixed deposit, your ability to hold it as NRE is a FEMA eligibility question. The interest exemption is a Section 10, subsection 4, clause 2 question tied to FEMA status or RBI permission. On return, the deposit gets redesignated into a resident bucket, and if you want foreign currency retention, the funds may be transferred to RFC by converting rupee into a permitted foreign currency, and then tax follows your income tax status. FCNR deposit, you can generally let it run until maturity at the contracted rate even after your return. Regulatorily, it is treated as resident from the date of return for most purposes. Tax-wise, FCNR interest is exempt for non-resident and RNOR under Income Tax Act, subject to foreign currency deposit being RBI approved. Once you become ROR, it is taxable. Remember, in Indian tax, exemption is never a vibe. Exemption is always a section number.